I'm going to tell you something that some of my accountant friends do not like me saying out loud, but it's absolutely true. In a small private firm, profit is whatever the owner says it is. And even in larger firms, you can play games with it. If you don't believe me, just Google Enron, Nortel, or WorldCom and see if you agree. The first example comes from when I led a company that, among other things, owned 9 mobile phone stores. We sold extended warranties, and they were very profitable, mostly because they were often sold and rarely used. Now, the president of that unit was an accountant, and quite brilliant actually. He figured out that because customers typically stopped using these phones after around 18 months, our actual warranty liability was a fraction of what was sitting on the books. He went to our auditor and made that argument, and after some negotiation, they agreed. The result was that we took $600,000 of warranty liability and moved it down to the equity line. However, due to the magic of accounting, it had to flow through the income statement to get there. So we created $600K of profit and $600K of additional owner's equity with the stroke of a pen. Looks great, but remember, no cash was created. It's not like there was anything extra to hand out to the shareholders. We just looked better. Now, another story comes from prior to that, when we were still private. Our accountant came to me during our audit, and he wanted to write down a bunch of inventory. His argument was that it was slow moving, and since we weren't having a banner year, I wasn't keen on that write down. It would have reduced our profits, and that would not have made us look good to the bank. So I explained how, yes, there's some slow-moving items there for sure, but our customers come to us because of our wide assortment of products in that category. And if you want to sell the fast movers, you have to have that assortment, which is going to inevitably include some slow movers. He agreed with me, and we didn't do the write-down. Now, the next year, we had a gangbuster year, and we needed to reduce profits to lower our tax bill. So I went back to the same accountant and said, maybe you were right about writing down that inventory last year. He just looked up at me with a smile and took the list in my hand and said, sure. This taught me that as long as you have reasonable arguments, you have a lot of leeway when it comes to profit. Now that's just the start. Depreciation, bad debt allowances, revenue recognition, warranty reserves, inventory valuation. Each one of these involves a judgment call, and each one affects net income or profit. And the person making that judgment call is you, the management. And that is why profit is whatever I say it is. The real lesson here involves cash. There's one financial statement that can't be manipulated: the cash flow statement. Cash went in or it didn't. Cash went out or it didn't. There's no accrual, there's no estimate, no judgment call, just tracking of money moving. That's why the one statement I look at first, and the one many small business operators never look at all, is the cash flow statement. Now I'm going to link a video in the comments to an explanation of it that you might find helpful. And if you're looking to up your game when it comes to planning your company's finances, especially cash, check out the free 3-year financial planning model that I've linked in the comments as well. Now lastly, my finance prof used to say, if it doesn't jingle, it doesn't count. And I use that saying all the time, because in any business, small or large, nothing matters more than the cash in the long run.